Welcome to Bloomberg Intelligence. BI provides research on industries, companies, and expert topics, delivering key data from BI analysts in their given industry. Now, here is your Bloomberg Intelligence research team.
Hi, everyone. I'd like to welcome you to the BI Energy Exchange, where we talk about our research and the latest developments in the market. First up today, we've got a decision from OPEC Plus on April 1st, and they're going to start gradually increasing their output. And for that, I want to bring on our colleague Salih Elmaz to talk about our research on Brent oil and the oil commodity in general. The oil market's been pretty ho-hum, Salih, sideways basically since the announcement. What do you make of it?
Sure. Thanks, Rob. So this wasn't actually quite the positive surprise that we have gotten used to getting from OPEC. I mean, our expectations, and I believe the consensus was very much for them to roll over the current level of output cuts for at least by a month. They didn't do that. They said they will gradually start increasing output in May. As you said, I think the initial positive spin and the takeaway by the market seemed to have been, because the oil was actually up on the day of after the meeting, was that the group seems confident about the prospects of demand recovery through summer. And I guess it is an exit plan. I mean, we were expecting them to give us an exit plan at some point, and perhaps this is as orderly as it could get. And I think another signpost that I would like to mention is Saudi Arabia, the de facto leader of the group, increased its OSPs, increased its prices for some of the key markets in Asia, which also speaks to their kind of confidence in the market. But I should mention, like when you look at India, which is one of the key markets for Saudi Arabia, we are seeing a resurgence in virus cases, and this is obviously going to pressure run rates, and I think it's a very similar story in Europe as well. But they are meeting every month now, and they will be meeting at the end of April again, so they do have that room to readjust their policy if they need to.
So, Salih, I want to stop you there because I think this demand conversation is really a fundamental backdrop to OPEC and everything going on in the oil market. Our colleagues at Bloomberg New Energy Finance put out their 2050 oil outlook this morning. Frankly, they're a bit bullish on demand, and I think they're expecting it to rise consistently for the next 15 years with a peak around 2035. Now, obviously, we've got a much more near-term focus, but what do you make of the current demand environment? You already mentioned India. What does Europe look like? How does China fit in with it? And where do you see things going over the next 6 to 12 months?
Sure. I must say we do remain a lot more cautious compared to Bloomberg New Energy Finance and some of the other some of the other agencies. And when you look at the near term, I mentioned India, I mentioned Europe, but when you look globally, we still do have lockdowns in place. We still do have travel restrictions, which are all bearish factors for the very near term demand outlook. I think there is a chance that oil demand may have peaked. We did hear IEA say gasoline demand may have peaked. And I think remote working is obviously having a huge impact on that. But when you look at jet fuel as well, which has been the part of the barrel that has been hit the hardest and is expected to come back and is expected to grow, but there's a lot of concern around the return of business travel there as well. So, when we look at accelerated EV adoption, when we look at teleworking for road fuels, and when we look at something as important as business travel longer term for aviation and aviation fuels, I think there are quite a few reasons to be cautious about prospects for oil demand. In the near term as well as perhaps the longer term.
It's very interesting to hear you say that. For folks who don't follow the aviation space, Ryanair put out a updated guidance this morning, and they have been the airline that's been the most positive about getting customers back in the skies. We're seeing a return to flying, but they came out and said, "Look, their fiscal 2022, which just began on April 1st, is going to be a lot more subdued than they had been previously thinking." So big read across there for oil demand. I want to shift gears though and talk about another topic that you recently worked on, Sally. You put out a focus idea last week on OMV, talking about their potential recovery this year, what it would mean for their cash flow, earnings, and what they could do with potential dividends, gearing, et cetera. So talk us through the focus idea and what you're seeing for OMV this year.
Sure. So I think there are a couple of strong points for OMV, and I think the most important one is their outlook for free cash flow. When we're looking at the financial framework for this year for the company, it looks like they might have more than 2 billion euros of free cash flow after dividends. I mean, this is quite strong. This implies about 15% in free cash flow yield, which is among the highest in the sector. And when you look at their plans for deleveraging, which is quite important for them, because as you might remember, last year they did the $4.7 billion Borealis acquisition because they're really pushing into petrochemicals. This has pushed their gearing ratio to above 40%, which I think has been a huge overhang on the company. But I mean, our calculations and scenario analysis suggest that they might have this free cash flow of more than 2 billion euros, which would give them the capability to bring that gearing ratio back down to 30%, which is their long-term target. And it looks like they could do this year. I think expectations were very much for them to take a couple of years to be able to do this. And to be honest, even the company themselves, I think, said this might take a couple of years. So if they really do deliver this, I think it's very positive for the company. And I mean, if our calculations are correct, and I think if oil price does remain relatively high, they could. They might even have a little bit of change left after reducing their gearing for a slim increase in dividends. And I think many people don't remember, but OMV was actually one of the few companies within the majors peer group not to have reduced their dividend. And it looks like they might be in a position to increase it slightly again this year as well.
Thank you, Sally. And for anyone who doesn't know about our focus ideas, you can find them on BI Focus on your Bloomberg terminal. And you really have to think of these as our highest conviction, most differentiated type calls. I encourage you to check them out. We're going to talk about one of our other ones in just a moment. But first, I want to bring on Will Hares, who covers the integrated oil majors for us here in London. Will, you just heard Solly talk through the financial framework for OMV. It sounds a lot like what we've just recently heard from BP, although I'm sure you can break it out better for us. So tell us what BP's up to and what they just indicated to the market.
Yeah, thanks, Rob. So very similar to OMV with Sally, net debt and gearing has been the singular issue hanging over the head of BP since the beginning of the pandemic. If you recall, the company slashed their dividend by 50% last year in efforts to try and mitigate their cash outflow. And just yesterday, management has updated the market on their debt situation. Which is a pleasant surprise. The company aims to or expects to have achieved their 2021 net debt target of $35 billion in the first quarter of this year. And that's a big improvement from our expectations and the general market's expectations of year end or even trailing into the next year. So this is a big improvement and a positive surprise, almost entirely due to the fact that the company has has received significant asset disposal proceeds through the first quarter of the year. They received $4.7 billion from a handful of separate asset sales, and this has been a major force in driving down that debt, along with obviously higher oil prices and good business performance as well. But I think most importantly, the takeaway from this is that previously BP management has said once they had hit their $35 billion net debt target, that would be the milestone at which they would begin to consider opening up and resuming their share buyback program. And so it's not explicitly laid out in the press release from BP, except it is a pretty clear head nod from BP CEO Bernard Looney that share buybacks should be expected to resume likely around mid-year or at their 2Q results when they report shortly.
Okay, Will, that's very interesting on BP. Maybe to shift gears a little bit and talk about your focus idea. We just heard about Sally's. I think you tied it into what's going on at BP, but you've got your own focus idea that you published last week on a completely different topic on the company Petrofac, and you looked at a sort of very interesting legal dispute saga that's been unfolding for the company. Tell us what you found and what you think lies ahead for Petrofac.
Absolutely. So Petrofac is one of my oil and gas service companies that I cover. And as you mentioned, they've been embroiled in a UK serious fraud office investigation for going on nearly 4 years now. And as a result of that investigation, there has been one former executive charged 14 times, and he's pled guilty to each of those 14 charges for bribery and corruption relating to the award of multiple contracts going back several years for the company, comprising a total of roughly $7.5 billion. So it's a significant criminality was involved here, and that's been proven by the UK's SFO. But my focus idea is on the outcome of the SFO's investigation. And typically what happens, and has historically happened, is that the Serious Fraud Office will offer what's called a DPA, or Deferred Prosecution Agreement, with a company that has committed illegal acts. And what it is an offer of amnesty in exchange for financial penalties and admission of guilt. And involved in that are those financial penalties. And based on our analysis and using previous DPAs as reference, we believe that Petrofac's risk for financial penalties from this investigation could be overstated by the market. And this is for a few reasons. There's been a total of 9 DPAs offered in the SFO's history, and 4 of them have been of material size, of hundreds of millions of pounds or euros. And certainly, when you look at the scale of the fraud and corruption that happened at Petrofac, it could justify large penalties in that scale. However, we believe that given the size of Petrofac, given the Serious Fraud Office's own policy, which dictates that the office cannot risk the business or layoffs or as a going concern, and also that the reputation of the company has already been harmed severely since the announcement of this investigation. Their market cap is down over 90% since May of 2017. The liquidity of the company would suggest that anything more than a handful of $100 million would be pretty devastating for the company moving forward. And so we just think there is a culmination of factors here that is suggestive that the SFO could include proportionality within the decision when this investigation wraps up. The one risk here that I'd like to flag is that we don't know when this investigation will wrap up. it's been going for 4 years. The average SFO investigation length is just about 4.5 years. But there is a risk that this could drag on, given the complexity and the number of contracts being investigated and the length of time which is being looked at.
Thank you, Will. I think we'll leave it there. But again, I encourage everyone listening, check out BI Focus. You'll find not just Will's idea on Petrofac, but also OMV, many others. Every focus idea has a set of catalysts that we'll be watching, so you can look through how key events may unfold and be watching for them. But with that, I want to switch gears and bring on our senior utilities analyst, Elchin Mammadov, to talk about some recent research that he's been working on that's quite interesting. And so, Elchin, you've been looking at rising bond yields and what that could mean for utility valuations. So break it down for us. Tell us what your research is showing. We want to learn more.
It's one of the main themes this year, coupled with a green stimulus. So it's a key driver for my sector this year. Obviously, rising bond yields have a twofold impact on utilities, by and large. On the positive side, it would help improve the returns for regulated network utilities. So not in the short term, but in the medium term. So whatever network utility has a rate case review in, let's say, 3-4 years time, if we assume bond yields gradually increasing, that could be a positive catalyst for them in terms of getting a higher allowed rate of return, or at least to make sure that the regulators don't cut rate of return too much. So that's a positive side. On the negative side, obviously rising bond yields is negative for utility valuations, especially for the regulated utilities. So if you're a network operator in Europe, on one side your earnings outlook is improving, on the other side your shares could potentially trade lower because investors are looking into more higher yielding assets. So there could be some capital rotation out of utilities industries. And within the sector, those that are not as much impacted on the valuation side could be the unregulated utilities or utilities with a high share of unregulated business. So we identify all these utilities in our report, so you can find the actual names in there too. And finally, the rising inflation and bond yields, obviously for regulated utilities, most of that is a pass-through, so they can pass through the cost of debt, higher cost of debt toward to their customers. However, for renewable developers, for example, that could be a headwind because in the past decade or so, we've seen bond yields consistently decline, and that's a major cost factor for wind farms and solar projects here. So that could be a headwind for renewable developers who will hopefully try to offset it with cost efficiencies and other measures. And also it's a negative for some unregulated utilities like hydropower and nuclear generators. So this is overall the impact. However, and final positive impact for my sector is nuclear decommissioning obligations, coal obligations, and I think it could also apply to some of Will's, Patricio's, and Sally's companies, because oil decommissioning obligations are all brought back to net present value. So the higher the bond yields and inflation assumptions, that could potentially reduce the present value of those long-term obligations. So if you have a utility with a large pension deficit or large nuclear decommissioning obligation, rising bond yield is good news for you. So the impact is multifaceted, but overall we see it as a negative for valuations, but slight positive for sector overall in terms of fundamental costs and earnings.
Elchin, you mentioned wind, solar, other renewables. IRENA put out a report just the other day saying that in 2020, about 82% of all capacity additions were wind, solar, and other renewables. So how do you reconcile this change with what you just talked about? And really, I think I want to bring Will and Solly back on in just a second to talk about this. But if renewables are representing this much of a share of incremental capacity, what does it mean for the gas as a bridge fuel narrative? Elchin, I believe you've managed to mute
Sorry,
yourself.
it depends on what your time horizon is. It's negative for gas in 10 years' time, but what we've seen, at least in Europe in the past few years, the gas demand in power sector has actually gone up. Yeah, so part of that coal and nuclear phase outs has been positive for gas, and that's going to be positive in the next few years. There's a supply crunch coming in Germany around 2023 when the nukes are coming off and coal phase out is continuing. So there's enough place for gas for sure, but in 10 years time, obviously that's a negative if your time horizon is that kind of period. So positive in the short term, negative in the long term. But yeah, the fact that we're 80% or plus of new capacity additions coming from renewables is purely the result of economics. It's cheaper to build new renewables. The battery storage technology is becoming cheaper, and we're seeing this hybrid solar plus battery or wind and plus battery projects proliferating. So that's great. And in the long term, it's definitely bad for gas. And as we've seen ESG investing gaining pace, some of the BlackRocks and Norges banks and whatnot, they started to divest some of the coal and fossil fuel shares. So that's going to make people think twice before investing in a coal-fired power plant that may be banned in 5-10 years' time. So, yeah.
Okay, so I want to turn back to Will and get your reaction to this as well. Clearly, one of the big pieces of the narrative for the integrated oil companies, the big energy companies, as they want to brand themselves these days, is the transition into gas as a lower carbon fuel. When you see a statistic like the one that Elchin was just talking about, what do you think it means? Is gas going to be a sustainable business for these companies over the next 10, 15, 20 years in your view?
Well, yeah. So I think that's the operative word there. It's the how many years are we looking into the future, and when you look at some of these oil majors that are considering constructing these mega project LNG facilities, tens and tens of billions of dollars, and with multi-decade asset lifespans, that is when I think these projects are looking a lot riskier when we're seeing just right now a third of Europe's power generation in the last few days was wind generated. Just on Easter Monday, the UK, I believe, hit a near record with nearly 2/3 of its power from solar and wind. And if you were looking at sinking tens of billions of dollars in an LNG plant that is planned to be operated at 2050, I think that this is introducing a new level of risk, because this scale of renewable power growth is climbing very quickly, and you're also seeing it from the oil majors as well, that they are also investing heavily in renewable capacity, sort of looking for that utility scale of 50 to 100 gigawatts of renewable power capacity over the next 10 years. So they're certainly in on the renewable space as well.
And so thank you, Will. And Solly, just quickly from you, when you look at this topic, you cover Saudi Aramco as one of your companies. How are they thinking about the energy transition, the role of gas? Are they fearful? How do they square this? Give us a quick sense on them.
Sure. I mean, I couldn't tell you if they're fearful about it or not, but I think there is increasing pressure for them to follow the footsteps of other international majors, to be kind of disclosing more information and perhaps coming up with more climate targets. But in terms of gas, yes, I mean, this has been just like many of the other oil majors and some of the integrators that I cover. kind of shift to gas and having a bigger share of gas in the production mix has been a big part of the major story. And this, as Will and Elchin mentioned, this does bring a new level of difficulty for them when they're looking at these gas projects and investing billions of dollars into them with very long-term project times. So yeah, I mean, it's going to be interesting to see, but I think over the last decade we've been hearing about gas, which was a huge part of their transition story.
Thank you, Sally. Okay, last but not least, I want to bring on Patricio Alvarez. Patricio, you've been looking at the oil patch in Latin America as part of your coverage. And I think that sort of to continue on this discussion here, you've been looking particularly at some of the divestment pressure in some of the more ecologically sensitive Amazon region. Tell us what you're seeing for the Latin American E&Ps and how this divestment pressure is building there and what you see.
Sure, thanks, Rob. What we've been seeing is sort of this fossil fuel divestment pressure percolating onto the most ecologically sensitive areas of the Amazon. These are called the sacred waters, basically the affluent rivers that connect to the Amazon River. These are jungle regions of northern Peru, southern Ecuador, and a little bit touching the south border of Colombia in the Putumayo. And how this is affecting our companies is because of the social impact that the company's operations have on these local indigenous communities, and sort of how that plays into this sustainability movement, and like sort of trying to improve their ESG profile. And as part of this, we've seen a couple of our companies exit Peru, especially the Morona block. That's northern Peru. We saw Geopark exit block 64, and Frontera Energy exit block 192, both in Peru, and both due to sustained local opposition that saw disruptions to the main infrastructure there for years at a time sometimes. So for us, that's not surprising. And on the other hand, what we saw is a couple of major financial institutions pledge to stop trading, basically trade financing as part of their portfolios, mainly ING and BNP Paribas.
Very interesting, Patricio. I want to shift gears now a little bit and bring it back to a topic that Elchin was just covering. Part of your coverage, it's very diverse. You're looking at Latin American E&Ps, but you're also looking at a company like SNAM here in Europe, gas pipeline operator. You've recently launched coverage on them, and I want to get your sense on the ideas that Elchin was just talking about with, rising bond yields, inflation, things like that. What's the read into a company like SNAM, and tell us about your outlook for the next 6 months?
Sure. I think to start, Elchin touched upon the point in the beginning, saying that it depends on the time frame in which you're seeing it. Perhaps in the midterm, it is a positive drawback into SNAM, but in the short term, there's a threat actually, because part of the determination of this rate of return over assets for SNAM is determined by the spread between Italian and government bond yields, which seem to be narrowing. And that's just sort of a juxtaposition of what Elchin said. But what we believe is that SNAM is actually trying to accelerate their capex and deploying more investment in the short run, sort of to make up for this potential drop in their WACC or their allowed returns. And the other caveat that we see is that regulators are in negotiations with the company at the time, and so there's no certainty that the other parameters of this WACC will be moved or negotiated differently. So we're taking a wait and see approach there.
Okay, very interesting, Patricio. I hope everyone's enjoyed the discussion today. As you can tell, the BI team here, we've got a wide portfolio of things that we're looking at. energy transition focus ideas. We're really trying to connect what's happening in the market today with the near-term investment case for the companies that we cover. If you don't know BI very well, please visit us on the terminal by going to BI Go and reach out to us if you have questions. We're happy to talk about our research at any time that you'd like. You can find us on IB, you can find us on the terminal, and I hope everyone has a great rest of their week.